Go back a couple of years and tell anyone who stays clued up on financial news and the markets that in 2021 we'd be staring down the barrel of stagflation, with the money supply soaring, supply shocks causing havoc upon our economy, employment figures decreasing and consumer sentiment dropping to decade-long lows, and they'd call you insane. Of course, if you also told them that there would be a worldwide pandemic that shut down every single country, killed millions and forced everyone else into lockdowns, they'd also claim that you'd been reading too much fiction as well. Nonetheless, this is where we stand today, with an economic situation that is far more precarious than the market would have you believe, where stagflation isn't just looking like it's maybe a possibility, but maybe even a probability. Many economists are starting to say that maybe stagflation is already here, you just don't know it yet. Today, that's what we're going to look at. We're going to take a deep dive into stagflation, what it is, what it means for our economies, and why it's starting to look increasingly likely. But first, really quickly, if you're new to the channel, make sure to subscribe. If you enjoyed this video, then hit that like button and leave a comment for the algorithm. Also, make sure to check out our Patreon. We're building a community of investors with loads of exclusive content, including buy and sell alerts and access to my own personal portfolio. So make sure to check that out if you want to support the channel. So despite the fact that lots of people have been talking about stagflation, its impact on an economy and whether or not we're really seeing it make a comeback, lots of people don't really seem to understand what it actually is. Some people get it a bit wrong and some people just outright don't know what stagflation is. Now in reality, there is a fair amount of disagreement regarding stagflation, what causes it, what it looks like and things like that. So try to remember when I'm explaining these concepts that this is my view on the issue, but I'm not some ultimate authority on the matter. Different people will think different things, some economists will agree with me and some will disagree. Very simply though, and at a pretty basic level, stagflation is when an economy becomes characterized by slow economic growth and relatively high unemployment or economic stagnation, and also at the same time, rising prices or inflation. Usually it occurs when the money supply is expanding while supply is being constrained. Now again, there's an important caveat to mention here. This term, stagflation, was coined in the 60s back when inflation had a different sort of meaning. Back then, inflation was a little bit more basic. It was simply the inflation of the money supply, or in layman's terms, it was when the government prints money, when they increase the number of dollars or pounds or euros in the system. Over time though, the term inflation has evolved to mean something different. So when you hear myself or the Fed or any other economist mention it, they're probably talking about the erosion of your purchasing power or the increase in the price of goods and services, not necessarily the money supply itself. Now, it was first used in the 60s, here where I live in the UK, while talking about inflation and stagnation both impacting the economy at the same time. It became a really popular term in the 70s in the US, however, when America suffered a recession, seeing very high inflation at the same time as unemployment rose and the economy suffered. This period actually led to the creation of something called the misery index, which is pretty simple. It's just the sum of inflation and unemployment, but it goes some way in showing just how badly people were being hurt. Now, this relationship between inflation and unemployment didn't make any sense to people for a long time because it was long believed that inflation and unemployment were trade-offs for one another, meaning that when one rose, the other fell. Keynesian economics basically stated that stagflation was therefore impossible. That was until it arrived. Because of that, there's been a fair bit of research into why and how stagflation happens and what might cause it in the future. Some believe that stagflation is closely linked to rising oil prices, and they point to 1973 when OPEC embargoed the West, causing oil prices to spike. It suddenly became far more expensive to transport or even produce goods, leading to consumer price rises at the same time as people lost their jobs, leading to high unemployment. There's also a theory that states that poor economic policies like those of President Nixon that led to the creation of the term the Nixon shock. To be perfectly honest though, and from my point of view, while these theories seem plausible when looking to confirm them, under even the slightest bit of scrutiny, they start to fall apart. There have been numerous oil shocks in the past that haven't led to stagflation, and there have been numerous recessions that saw unemployment and inflation rise without the short-sighted policies that were seen under Nixon. One theory that actually does hold some weight, although I'm personally not entirely convinced by it, is the potential link between the end of the gold standard, the creation of fiat currencies, and stagflation. Nixon removed the last elements of gold-backed currencies, which opened the floodgates for monetary expansion and the devaluation of our currencies. Since then, there's been a pretty clear link between inflation and unemployment, whereby we usually see them both rise as recessions come about. There's also the idea that because consumers adjust their behavior in response to monetary expansion, that when money printing doesn't lead to a decrease in unemployment, it will instead simply lead to inflating prices, while not actually stimulating the economy and creating any real growth. What all of this really means to say is that usually we expect to see stagflation when the money supply is expanding at the same time as supply is being constrained. Now, if that sounds at all familiar to you, good, because it should. We've just seen the greatest monetary expansion in history, not only in the US, but in countless other countries as well. And we are also seeing supply constraints in every country as well. The money printer has been turned on, and yet shipping delays are everywhere. Factories are unable to run at full capacity, and an energy crisis has dawned upon us. We are, in my opinion at least, very likely about to see the next stagflationary period develop before our eyes, and I'm going to tell you why. Inflation is high, really high, far higher than most people realize. Data for the US came out just a few days ago, and over the last month alone, prices across the country rose by 0.9%. Annualized, that's 11.3%, and that is after an entire year of already high inflation of 6.2%. Every single day, the money in your wallet or your bank account is disappearing right in front of your eyes. You might be watching this and thinking, oh, well, I'm not American, I don't own any US dollars, so that really doesn't matter to me. But the chances are that it does. Because inflation isn't just high in the US, it's high almost everywhere else as well. The US may be further along in their inflationary cycle. The UK and Europe are certainly a few months behind the US, but we're heading in the same direction. Now, over the last year, there have been a lot of apologists for the Fed and their actions. A lot of people have been making excuses for them, claiming that their hands were tied, that they didn't have a choice, and that it's not even their fault. But when high inflation started to occur, the narrative that was pushed was that it was a momentary blip, and a small one at that, so there was no real reason to be worried at all. Then, when that came out to be false, they said that, okay, maybe inflation was a little bit higher than they claimed, but don't worry, it's staying in line with expectations, and before long, it will be back to normal, so there's no need to worry at all. Then, the mainstream media started to politicize inflation, to claim that Republicans or the right-wing media was pushing this false narrative about inflation to drive up fear and damage the Democratic Party. Following that, they simply told us to shut up. They told us that we shouldn't be allowed to complain or worry about it because it's all our own fault, and it's the fault of our expectations being too high. Finally, once it's become clear that inflation is here and the mainstream media had been wrong all along, they told us that it's good for us, that we need it, and that it's only the rich who will suffer, which literally couldn't be further from the truth. Now, there are still some disagreements surrounding inflation today, but unsurprisingly enough, it's those who have been wrong about inflation at every possible opportunity who are trying to tell you that the obvious answer is not true. Yes, there are supply-side shocks around the world right now, and yes, they are increasing costs, increasing shipping times, and creating inflation, but they are not the only thing at play. It is simply not credible to claim that increasing the money supply by 30% in under a year will have no impact on inflation. To claim that literally sending out checks of money to people in order to stimulate spending has no impact on demand or inflation. To increase benefits for those choosing not to work, to spend obscene amounts of money on unnecessary projects that won't be worth it in the long run. I am not here to deny that supply-side shocks are real, or to claim that the energy crisis is a non-issue. I've literally made videos documenting and explaining the causes of these problems. I am by no means trying to downplay them. The velocity of money may be low, but that is in part due to these supply-side shocks, not in spite of them. Demand for goods and services is high, and the supply of those same goods and services is low. Inflation does not have to be attributed to one or the other, supply or demand. It is very clear to anyone who has been paying attention that it is a function of both. Now, if you recall, just a few minutes ago, I showed you what usually leads to stagflation. It is the expansion of the money supply at the same time as there are supply-side problems. In 20 years or so, there is a very good chance that students will be reading about 2021 and the developing stagflation situation, and they will point to metrics like the M2 money supply and the cost of transport as key indicators of what was about to come. But of course, inflation is only one side of the coin. Stagnation is just as, if not more important than inflation when considering what is the real misery creator here. Now, while most people choose to quantify stagnation using unemployment figures, the two are not the same, and the methods used to determine unemployment figures need to be accounted for. Also, we can measure stagnation by looking at consumer sentiment or the Purchasing Managers Index or other metrics to determine the direction an economy is moving in and how quickly. Over the last year, since the initial shock from the pandemic, employment figures have been going up, and the number of unemployed people has been going down, and that seems to be really positive, or at least that's what it looks like on the surface. Labour force participation, however, has not been increasing as you would expect. In short, this is because unemployment figures usually look for people who are applying for jobs but are out of work, but not those who haven't looked for jobs for a certain amount of time or who have no indication of looking for jobs at all. Over 4 million people are quitting their jobs each month, numbers which would have seemed crazy just a couple years ago, and many of these people are not looking for new employment, which actually aids the unemployment figures. There are record levels of job openings in the country, and yet they're not being filled. Consumer sentiment reports show that the average American is more worried about the economy today than they were during the peak of the COVID pandemic, and this will cause people to adjust their spending habits. The US Purchasing Managers Index showed growth slowing over the last month as manufacturers struggle with supply constraints and rising prices. The actual data that underlines the US economy that isn't being doctored by the Fed or the US government is not as positive as some people would have you believe, and this is the other side of the coin to stagflation. This is stagnation. It can be hard to see through the smoke and mirrors of mainstream media, but it's important to think critically about what we're hearing. When someone tells you that inflation only hurts the 1%, ask them why. Challenge them on their claims, or even just think about it for yourself. Consider whether or not milk doubling in price is going to hurt you or Jeff Bezos more, and the answer should be pretty clear. Consider whether or not the stock market soaring in value is going to help you or Jeff Bezos more, and again, it should be even more obvious. Stagflation is dangerous, and we shouldn't be gaslighted into believing otherwise by media organizations whose only goal is to make sure the party that they like is in power. Now, I know a lot of people come here asking questions about the best way to invest, but the truth is, I can't tell you that. Everyone's needs are different, everyone's aims or goals are different, as are our risk tolerances. Historically, certain investments have done better than others during stagflation, but that doesn't necessarily mean they will perform the same way during the next period. Commodities have often performed well, as have certain value stocks that have healthy free cash flows and strong dividends, especially those that may see better results when the economy isn't looking so great, like Walmart. Equities and bonds, though, often get squeezed with high inflation, which can make them perform less well than many would have liked. The truth is, this is where you need to stop watching YouTube videos and do some research based on your own circumstances and work out what a healthy portfolio looks like for you. You now know what stagflation is, you know what causes it, you know why there are many people worrying that it might be in store for us for the future, and that's half the job done. But the rest needs to be done on your own. Now, to all the regular viewers of the channel, I am right in the process of moving house. I'm setting up my new office space and I have loads of admin to do, so I apologize if the consistency of this video isn't quite what you've come to expect over the last few days. I promise it'll be back to usual, except hopefully with a far better backdrop in no time. If you're new here, then consider checking out our Patreon. We're building a community of like-minded investors where we can talk and discuss all kinds of ideas just like we do on this channel. You also get access to loads of exclusive content that isn't available anywhere else, early access to all videos, private live streams, and buy and sell alerts for my own personal portfolio. We've also almost met our goal of reaching 100 patrons, and once we do, I'm going to hire a full-time video editor to help me put out even more content just like this. If you enjoyed this video, then make sure to subscribe. If you want to help spread the word, then consider liking the video and leaving a comment, and YouTube will do its part by pushing this video out to more people just like you. I really do appreciate all the support you give the channel, even if it's just leaving a like. There's also a link down below in the description to my other channel that you can check out as well. Finally, there's also a link to BLOCKFI where you can get up to $250 in free Bitcoin, and you can earn interest on whatever crypto you hold, whether it's Bitcoin, Ether, or stablecoins. You can earn as much as 9% interest a year. I personally hold about $15,000 on BLOCKFI in the form of stablecoins, which earns me 9% interest, while still being able to access that cash if there's a market downturn, but I don't have to put up with the measly 0.1% returns I'd get on a savings account. So if that sounds interesting to you at all, then make sure to check out BLOCKFI. Thanks for all the support recently, thanks for watching, stay stoic, until next time.